Expect to make no money in bonds going forward. Now, that doesn't mean you don't own bonds. I'll share with you why that is. But don't expect to make any money at all, net of inflation, in bonds going forward. And I'll share with you why. All right, so we're going to go back to my man Ed McQuarrie's. This is just such a great piece here. It's fundamental. Stocks for the long run, sometimes yes, sometimes no. But he also looks at bonds as well. So we're going to come back down to here and see the bright red. And what you see is you have 10, 20, 30, and 40 year and 50-year time frames annualized for bond real returns, net of inflation. And you can see I'm looking at about we'll start with 3%. 3% rate of returns, net of inflation. Bonds smoked that until about 1923. All right, 1923 on, bonds did not do very well relative to inflation. I mean, they still did fine, but net of inflation, you can see a significant drop in rates of return. All right, so again, we got the 50-year right here. We got the 30-year, we got the 20-year. So I'm looking at 3%. We only really have for 20-year, 30-year time frames, that red right there. Basically, from basically the previous 30 years, from 1900s to 1930s, we averaged about 3% real. And then it just fell off a cliff. We never got back to 3% real until 1993. So from 1964 to 1993, we started averaging 3% real again for rolling 30-year time frames. And we can see it's going up. And for the last basically 30 years, we've averaged over 3% real. And you can see it's gone up and up. Now it's starting to go down again. All right, so that's interesting. So and then if you look at the 50-year time frames, you can see from 1923 on a rolling 50-year time frame, it just fell kapoop until about 1983, which is what happened. Oh, that's when interest rates are at their highest, and then the interest rates started going down. You can see a significant run up in the 50-year time frames. But all we care about is 30-year because that's usually what we plan for retirement. Anyway, so you can see the bonds have never really breached 3%. They never got anywhere near 3% on the beginning of the history of the markets, and basically never really breached 3% until about 1982. For a 30-year time frame until about 1993, and then it smoked it from 1993 until about now, and now it's starting to come back down again, and it'll continue to do so. So let me show you what I'm talking about. So if we go to Vanguard. Hold on, pause it real quick. Vanguard bond funds is our proxy. I'm going to take the long-term investment grade fund, which has gone around since 1973, and then I'm going to take the short-term investment grade fund, which has been around since 1982. So all we need is from 1992 to 2021, and those will give us that. And you can see the short-term investment grade is paying 2.25 basically right now. The long-term investment grade is paying 3.32. So for simplicity, we take 3.32 plus 2.25. Divide by half, that gives us a 2.8%. That's our SEC yield, 30-day yield. If we had half in short term, half in long term. And then if we look at the intermediate term, we got, I just saw it right there someplace. Where was that? Short term, intermediate. Hold on just a second. Intermediate here, 3%. So I'm basically spot on. All right. So basically what we're getting, we're going to get about 2.8%. Before inflation rate of return on bonds. We can round up to say 3. I'm fine with that. All right, so now we're going to go back and we're going to say, okay, so what did net of inflation from 1992 to 2021 do the short-term bond fund do? If we take $10,000 as our present value, I think which calculator was I using? Maybe I was using this one. I can't remember. $10,000 is our present value, and at the end of 30 years is worth $17,000. 30 years end, zero payment. We've averaged 1.8% a year in the short-term fund, real return. In the long-term fund, we ended up with 42,000 as our present value, 42,636. We averaged 5% a year from 1992. Just make sure that's right. Yeah, from 1992 until 2021. So 5, what did we say the other one was? 1.7. So 4.92. And again, I can't remember what it was. 17,355. Yes, 1.8. So 1.85 plus 4.92 divided by 2 We've averaged 3.38% a year if we had a combination of the short-term investment grade and long-term investment grade. Net of inflation, ain't too shabby. If we go back to Ed's thing here, we'll just say 3.5. So right about there. All right, so you can see we had nothing there, and that's the post-war times. And then right here, we're smoking the 3.5, smoking 3.5, smoking 3.5 for 30 years right there. And ever since 1993, we've been above 3.5 average ever since. But what happens now? Well, what happens is you can literally, let me just go back. We know I can't say a fact, but we have pretty good idea that you're going to get the rate of return as a current SEC yield, which is 3.32 for the long term. What I say, 2.25 for the short term. And so we factor in those. We just assumed a 3%. And what am I using for inflation? I'm using 2.5 for regular cost of living adjustments increases, 5.5 for healthcare, and 3 for housing cost increases. So basically, if you factor all that in, you're looking at about 3% inflation. 3% SEC yield minus 3% inflation is no income and no returns in bonds whatsoever. So net of inflation, bonds won't give you any money. All right, because I'm using basically 3% inflation, 3% yield on bonds. You're basically breaking even. Net of inflation, I already showed you I'm using 3% net of inflation for stocks. All right, because I'm giving 6.5% rate of return on stocks minus about 3% inflation, 3 to 3.5. That's it, my friends. That's what I'm using in my right capital. So if you are, now this is net of inflation. You could say before inflation, 3% on bonds, 6.5% on stocks. I think I'm saying, what did I say? 2.5% on bonds, 6.5% on stocks. Frankly, it doesn't matter that much because when you're netting of inflation is what matters. But anyway, when you're comparing apples to apples, just remember, I'm pretty conservative in my stuff because I actually think this is. Lots of data says the probability of you getting much different from the current SEC yield on your bond fund isn't very high. 95 and 98% probability of what your returns will be based on current SEC yields historically. And I completely agree with that. Now, again, that doesn't mean you don't buy bonds. I'm just telling you, I'm going to do another video on why you need to buy bonds because I've done this before after having changed my mind about the efficiency of bonds. Bonds you don't buy bonds to give you growth. You buy bonds for protection. And I'm going to show you how important that is. All right. Love your thoughts. We'll see you.